Good afternoon and welcome to the session of Solid Finances today. I'd like to start off by thanking our sponsors, the universities who helped to put on this webinar series for you. Montana State University Extension, North Dakota State University Extension Service, University of Idaho Extension, and Kansas State Research and Extension. For those of you who may have not been on in the past or others, just kind of a reminder of where you can find resources for Solid Finances. Our website, msuextension.org/Solid Finances. You can view the upcoming schedule, any contact information if you have questions from any of the webinars, or if there are sessions that you'd like to see in the future. Or just want to reach out and ask us questions even if they don't pertain to particular sessions that we've held in the past. You can also see recordings of any of our past sessions, session resources, so links to any materials that we reference in our presentations will be available to you as well. And those resources for today are also already posted, so if you want to kind of take a look and see what I'm referencing when I'm speaking today, you can take a look at that. Some interactive tools. So if you do have questions as we go along today, I encourage you to please type them in at the bottom of your screen. They are completely anonymous, so nobody will know that you're asking them. And then also I will have a few polls as I go through today, and some will be kind of just get to know my audience, see who's here, and also kind of gauge your level of knowledge. Some upcoming sessions. So today is on home buying, and next week Joel from MSU Extension will be looking at some items particular to home loans. And then we're going to take a break for almost a month, and then we will come back and I will have a presentation on student loan repayment options. So today I am going to be presenting a session on home buying, so different steps that you need to take as you are preparing to buy a home. My name is Carrie Johnson. I'm an extension specialist and assistant professor with North Dakota State University Extension. So this is just to kind of get to know where you're at. So those of you who are on live today, are you planning on buying a new home in the next 18 months? And I say 18 months, and we'll kind of go through the process of purchasing a house and what you all need to get to take a look at and realize that maybe you should start planning more than just a month or two ahead of time. So it looks like there are some of you yes and some of you maybe, and then some no, so just on for educational purposes, which is fine as well. Now, have you ever purchased a home? Let me get this poll ready for you here. Oops, sorry, this is not the correct one. Hold on just a second. There we go. So have you purchased a home in the past? So in the past 10 years, over 10 years ago, or never purchased a home before? Okay, so we do have a mixture as well on this as well. So some of you over 10 years ago, so if you haven't purchased a home for over 10 years and are looking at purchasing a home now, it is different, the process. There have been some new regulations and rules put into place, so you may realize that it's not the same as it was 10 or 11 years ago. And then some have purchased a home within the last 10 years. And then others have not. So how I wanted to get started is, so yes, next week we will be Joel will be talking about home loans. However, today, just kind of a quick overview of the different types of home loans that are available to consumers. So there are conventional loans. These are the most popular type of mortgages used today. A conventional mortgage is a conforming loan because it meets the standards set by Fannie Mae and Freddie Mac. So a down payment is typically required. You can apply for some that may have lower down payments than a 20%. However, if you have less than 20% down on a home when you're using a conventional loan, you will have to pay private mortgage insurance. And then there are government home loans available to consumers as well. So there are FHA loans. The FHA promises to pay lenders if a borrower defaults on an FHA loan. So these are low down payments, so you can get a loan with as low as 3.5% depending on your credit score. So the lower your credit, the higher down payment you're going to be required to come up with. They are easier to qualify for than conventional loans, and we'll talk about the different credit scoring requirements for these different types of loans as we get through this session today. And the mortgage insurance, this is required with an FHA loan. It's an obligation and it's a fee to the borrower. Home buyers who use FHA loans pay an upfront mortgage insurance premium of 1.75%, and you'll also pay a modest ongoing fee with each monthly payment to pay for your mortgage insurance. The amount you pay depends on the risk the FHA takes with your loan. So shorter term loans, smaller balances, and a larger down payment will result in a lower monthly insurance cost to the consumer. VA loans, these are available to veterans. So these have no down payment. They do have a no down payment option, so they'll fund up to 100% of the market rate for whatever home you're going to be purchasing. However, there is a 3% what they call funding fee. So that 3% is on top of the purchase price of your home. And you can actually roll that 3% into the mortgage. So the only thing with doing that is you will pay interest on that as well. So the lender will go ahead and add that on top of the mortgage and make that part of your loan. Now there are USDA mortgages as well. So this program, they're mortgages in rural areas. If you actually go on the website, the USDA website, you can see that over 95% of the U.S. is eligible to take out a USDA rural development loan. And then on their website you can find links to each of the states if you're interested in something like this. But there are two different types. So there's a USDA guaranteed. So this is a program that assists approved lenders in providing low and moderate income households the opportunity to own adequate, modest, decent, and safe dwellings as their primary residence, as long as they're in an eligible rural area. Eligible applicants may build, rehabilitate, improve, or relocate a dwelling in an eligible rural area. The program does provide 90% loan note guarantee to approved lenders in order to reduce the risk of extending the 100% loans to the eligible consumers. And then there are the USDA Direct Loan Program. So a little bit different than the guaranteed. So if you're borrowing a USDA Direct, this is also known as a Section 502 direct loan. This program assists those low-income applicants to obtain a decent homes and dwellings in eligible rural areas by providing payment assistance to increase an applicant's repayment ability. So the payment assistance is a type of subsidy that reduces the mortgage payment for a short time. And the amount of that assistance is determined by the adjusted family income. Now, so just remember, if you look on that resource sheet, you should be able to find links to all of these different programs, so you can do a little more research on your own as well. Just kind of as a reminder, so the information today is going to be kind of that broad overview, very generic. If you have specific questions, you can email us and we can find that for you. Or I always suggest to people, if you have specific questions like a banker could answer or a realtor, feel free to reach out to somebody in your community as well. But just kind of that overall picture of buying a home, there's kind of those 4 main steps, and we'll go through each of these in detail. So how much can you afford? It's kind of step 1 when you start thinking about buying a new house. Step 2, prepare your finances. Step 3, time to go mortgage shopping, not just house shopping, but you want to shop around for your mortgage, and we'll talk about that. And then enjoying your dream home. So when we ask how much can you afford, what are banks really looking for when you ask that question? So if you go in and say, I want a mortgage, what's the biggest mortgage I can take out? So when they're looking at you to pre-approve you for a certain amount, what are they looking at? So they're looking at your debt to income ratio. And there are 2 different debt to income ratios that lenders are concerned with. So there's a front end ratio. This is the dollar amount of your home related expenses, so your mortgage, your property tax, your insurance, any homeowner association fees, and then divide that by your monthly gross income. And then there's a back end ratio, and that is all of the debts you pay each month. So your housing plus credit cards, student loans, car loans, anything that you have to pay, any debts, and that is then divided by your monthly gross income. So I do have an example here. So here's an example of a front end versus a back end debt to income ratio. So let's say this person has, or this family has a monthly gross income of $6,000. These are the proposed housing expenses. So they're looking at a house that has a $1,300 mortgage, $100 a month in insurance, and $200 a month for property tax. So you can see that this person's front end debt to income ratio is 25%. And then their back end debt to income ratio, you can see they have a student loan, a car loan, and some credit card debt of $750. So if you add that to the $1,500 they already have for housing expenses, that leaves them with a back end ratio of 37.5%. So what does that all mean? What do lenders really care about? So you've figured out your debt to income ratio, you know what it is. What do lenders really care for? There are a few rules of thumb that those of us in the financial planning world say, your front end ratio, no more than 28%, and then back end, no more than 36%. And it kind of leaves you some wiggle room for emergencies and that type of thing. But most lenders will focus more on the back end and not the front end. And then each type of loan may determine what your ratio can be. So these are some recommended DTIs for the different types of loans. Now with your conventional loan, they say a back end of no more than 45%. Again, each lender can kind of make a little adjustment to these, but these are just kind of those standard in the marketplace what they suggest. FHA loans, a 31% front end and a 43% back end. VA loans is 41% back end, and then your USDA has a 29 and a 41. So, when was the last time you calculated your debt to income ratio? And there's no judging here, just kind of curious if anyone has done it. Usually when I start shopping around for new, like a new car or when we were buying a house, that's typically when I'll do mine. I don't typically do it every month or anything, but so we've got about 50-50, some 50% never and 50% in the last 6 months. And now that you know how, you can go ahead and do that as well. The pre-approval process, so preparing your finances. So before you even go to a bank, before you talk to a lender, I always tell people check your credit report. Pull a free credit report from annualcreditreport.com from one of the 3 major credit bureaus and take a look at it. Is there anything on there that just doesn't seem right? Do you have a judgment on there that should not be on there? Do you have a credit card listed under your name that should not be listed? Make sure to pull at least one of your credit reports and clean up any inconsistencies. So if there's any mistakes, get that taken care of before going to a lender, or you might be blindsided when you find out that there's something on there that should not be. Each lender is going to ask you to complete an application. It's basically a net worth statement. So any loan application typically is going to ask you, what are your assets? How much money do you have on hand, cash, savings, checking? What are your vehicles worth? Do you have anything else of value? And then it will ask you to list your liabilities, so all of your debts. Now, they will also pull your credit score and your credit reports, but they do ask you to fill out that application. When we moved here, I just asked the lender, do you really want me to put the liabilities on the application? You're going to pull the credit report anyway. He said, don't worry about that, just fill out the other stuff. So if you don't want to actually sit down and fill it all out, I suppose you could ask them if you have to, or if they can just get that information from your credit report. Other things that lenders may ask for just during the pre-approval process. Again, I bought a house less than 2 years ago here in Fargo, and these are most of these are things that I turned in during the pre-approval process. So the most recent W-2s, your 2. If you're self-employed, your 1099s. Last 2 years of tax returns, they do ask for those. Now, they'll ask for those up front during the pre-approval process, but then down the road, they'll actually ask you to fill out a form saying that they can then pull your income tax transcripts from the IRS. They do both. And then they'll ask if you have any real estate income, submitting documentation of that. They ask you for copies of your bank statements. They ask for copies of any retirement or brokerage account statements. The listed debts, that's typically going to be on your application. Proof of rent. So if you're a first-time home buyer and you've been renting, they will ask you for 1 year proof of rent, which a few years ago when we bought our house in South Dakota, I had to go through and get canceled checks because we had rented for 1 year before buying our house, and then going through and finding canceled checks. And now I think about it going, how would I do that? Because I don't get canceled checks anymore, but I suppose your bank statements will have that on there. Divorce decree. So if you have recently gone through a divorce or have gone through a divorce, they may ask for that to check if you are responsible for any child support or alimony, spousal support. Bankruptcy or foreclosure letter. So if you have gone through a bankruptcy or a foreclosure in a certain period of time, typically 10 years because that's how long it's going to be on your credit report, they are going to ask you to write a letter explaining why you went through one of these two things. So on bankruptcy, they just want you to give them a statement of what happened, where you're at now, why it's different. Down payment and or closing cost letter. This one I was a little surprised about when I had to do this last year. They're basically asking you need to verify where the money came from for your down payment and your closing costs. So I basically had to write a letter saying, my husband and I both have jobs, we both work, and we've been putting money away in savings for the last year or so. So they just want to verify that the money that you are using for your closing costs and your down payment are not a loan, or you didn't borrow it from somebody else. Employer certification. So if you're moving for a new job, they will ask you to have your employer certify that you will be working there in the future. And then if you are doing a VA loan, they will ask you for your certificate of eligibility. Now, after that long list of items just in the pre-approval stage, some lenders may ask you for more than just that. So it is a process just to get pre-qualified and pre-approved for a loan. Minimum credit scores. Now these, again, each lender is going to set their own, but there's kind of some common benchmarks. Conventional loan about 640. FHA 580. So as you can see, those loans are a little less strict when it comes to credit scores. So people with less than perfect credit can apply and receive an FHA loan. VA is a 620 and USDA 640. So what if your credit scores are less than the benchmarks I just mentioned? So there are ways to increase your credit score. And if you are curious and you want to know more about how to increase your credit score, you can go to some of the past recordings. We do have sessions on credit scores and credit reports. But pay down your debt, especially your revolving debt. So if you do have credit card debt, that is the biggest impact that you can have, is to pay off some of that debt. Keeping your used credit at 30% or less is always a good benchmark to try and meet. However, that might not be possible for everybody. You might not be able to just pay down your debt quite that quickly. But if you are kind of maxing out some of those credit cards, if you can get it down to 50%, it's going to make a big difference. Each of your credit cards or your loan companies do report to the 3 major credit bureaus typically every month, so you can actually see an increase in your credit score within a month. So if you're diligent, and especially if you're planning ahead, if you're a year or so out, you've got some time to think about that. But if you're cutting it close, and you're maybe 5 to 10 points away from those minimum credit scores, you can go ahead and probably get to that credit score you need within a month or so. Again, pulling your credit report, making sure that everything on there is correct. Get any incorrect data removed from that credit report. And then don't apply for any other new credit at this point. So be careful not to open other, don't take out a car loan, don't apply for a credit card. Just be really cognizant of what you need to do to get your mortgage, and don't mess too much with your credit during the time you're trying to get a mortgage. Just as an FYI, if you do apply for and receive new credit, the bank will actually have you write a letter stating why you applied for new credit and what it's going to be used for and that type of thing as well. So shop around for the best rate. So check with multiple lenders. You don't want to just walk into your hometown bank and say, I need a mortgage, and then sign on the dotted line and do it that way. That may be the bank you end up going with, but you want to kind of shop around and check interest rates at different banks. Or you can use a mortgage broker. A mortgage broker is basically you submit one application, and that mortgage broker then does the shopping around for you and finds the lowest interest rate that would work for you. So that is an option if you don't want to apply for multiple loans on your own. So what do you think? What is the time frame that you can have multiple credit checks from a mortgage lender to count as one inquiry? So you've decided, I do need a mortgage, I'm going to do some shopping around, and you start applying let's say you apply for loans from 4 different banks. Okay. All right, so just an FYI, anything within a 45-day window, multiple credit checks from mortgage lenders are recorded on your credit report as a single inquiry. So you have a month and a half to apply for mortgages from multiple companies, and it only dinging your credit. I say dinging. Different inquiries do put will decrease your credit score a little bit. And then you can then shop around to get multiple pre-approvals and official loan estimates. I do have a comment that came in about mortgage brokers. Downside to using mortgage brokers, sounds like it would be good to have someone shop for me. Okay, it's a good point. I've actually done it both ways. I've used a mortgage broker in the past, and I've also used just a lender. I liked having the mortgage broker, and when I purchased that home, it was a house that was for sale by owner, and I did not have a realtor. They did not have a realtor, and this mortgage broker, I think, kind of went above and beyond, and he did help us complete all the paperwork to help us through the sale of the home. So we didn't have to pay commission to a realtor. The downside of a mortgage broker, sometimes there will be additional fees because that mortgage broker is doing some extra work, so they may have additional fees, and they get paid. The mortgage broker gets paid by the lender, so once you close on the house, so there might be those additional closing costs. So always read contracts, always kind of look and ask if you decide to go with a mortgage broker company, what are your fees, how are you paid, are those seller or buyer closing costs, and that will help you determine if that's the way to go or not. Yeah, potential conflict of interest if the broker gets paid by more by one company than another. That's a very good point. But I just always say do your research. Make sure, like I said, I haven't had any issues with using either a mortgage broker or just a lender that I found that after doing some shopping around on my own. So. But again, we didn't have the realtor fees. We didn't have to pay that closing cost, so having the mortgage broker fee was less than having a realtor. So, all right. So, speaking of realtors, working with a realtor, work with somebody who's knowledgeable, especially in your area, is essential. This time buying a house, it was the first time I ever used a realtor because I was moving to an area I had no clue about. In the past, it was kind of, I found a house online or in the newspaper, and that's how we had done it in the past. But having that realtor is really important, and making sure that you're comfortable with them. You can interview different realtors, but just make sure if you're in that interview stage that you say, I'm just interviewing different realtors at this point in time. And don't sign anything if you don't understand it, because once, you can sign with a realtor and then they represent you. Some realtors will not show you properties until you have that pre-approval from the bank, so remember that. And that's why I say get that done first, because they might say, well, unless you're pre-approved, you really can't make an offer, that type of thing. So, and then again, making sure that they know the area. So, time for the fun part. So all the paperwork's behind you. You've been pre-approved, pre-qualified. They kind of use those words interchangeably. Some people say you need a pre-qualification. Some say you need a pre-approval. Basically, it's basically the same thing if you go through all those steps and make sure that you are really pre-approved. So look at properties. Again, I'm sure all of you have been online and you Google different properties in my area, that type of thing. Give your realtor that list of your needs and wants for your new home and the location. And then if you attend an open house, check to see if your realtor wants to attend with you. And then you may find properties that you want to look at, but and then have your realtor set up those showings. Don't forget about taxes when you're looking at properties. When looking at homes, make sure that you ask about taxes on the property. So what are the property taxes? And what we found in Fargo that we did not know is that here we have what are called special assessment taxes. And this is listed nowhere in the listing information when you're looking at homes online. But basically, special assessments here are kind of pays for the infrastructure, so roads and gutters and all that stuff. So on each property in the city, there are these special assessments on top of your property taxes. So do you have special assessments where you live? This was the first time I had ever heard of them. It wasn't something that I was ever familiar with, and when my realtor brought it up, I was a little shocked. I had never heard of it before. And they can be quite expensive. I know when we were looking at new construction, they were anywhere from $40,000 to $60,000. Now, on homes that were 10 years old, they're closer to that $10,000 to $15,000 range. And then basically what it is the city gives you a loan at a certain percentage, and you pay that with your property taxes every year. So it can be a quite large chunk of change, so really be on the lookout for anything like that. Homeowner fees, excuse me, our homeowner association fees, that might add up as well. So just don't forget those other things that you may overlook when you find a property that you've completely fallen in love with. Well, if it's in a neighborhood that does have a large HOA fee, so your homeowners association fee, you may not actually be able to afford it once you add that to it. So, making an offer. You found the house you want, you've been pre-approved, so now you've made an offer. Oh, so what are examples of special assessments? Is it a college, a community college? So to answer that question, where I live, the special tax assessment is just for like road maintenance, building new roads, lighting in the community. So if you move to, let's say, a brand new development, they are going to be higher because they're building new roads. Now, every few years, they add to it. So just give you a personal example. This year, I got a special tax assessment that will be added to our tax assessment for $2,000 and some dollars, so they could seal coat the road. So it's basically anything within a certain distance of our home that has to do with kind of that infrastructure. We pay to have that done. And that's on top of our property taxes. So it is different. And I didn't know if there's a lot of areas within the country that do that. I just know here in our city we have those. So again, just something to be on the lookout for, and think about asking if you have a realtor, ask them if that property has anything like that. So when I was working with a bank from out of state, they had never heard of it, and they were confused when they got the statement, and I just had my realtor call them and take care of it and explain what it was. So, but once you make an offer, it can be either kind of flat out rejected. So if you're really off of what the sellers are looking for, they can just reject it. They can come back and counter saying, asking for a little more. It's kind of that negotiation period. Or it can be just accepted the way it's written. And your realtor will help you write your offer. And a lot of times they're going to ask you to include your pre-approval letter from the bank. And they also may, they're probably going to ask you for an earnest money deposit. So this is proof as a buyer that you want to purchase this home. The amount really depends on kind of where you live. I know here in Fargo it's common practice as 1%. So 1% of the sale of the home you need to have ready, and you write a check. And then that money is put towards your down payment when the transaction is finalized. But it's really kind of your, yes, I'm interested in the house, yes, I'm serious, so you write out this check. Other, earnest money can be anywhere from 1 to 3% of the purchase price of the home. So really something to think about once you start looking at homes and are ready to make an offer. You need to have some of that money set aside and ready to go. So you've got an accepted offer. You think you're done, right? Not quite. So this is just kind of the, oh, finally we got an offer accepted. We're ready to move on to the next stage of things. So on average, after an offer is accepted, how long does it take for closing on a home loan, on a mortgage? Okay. All right, so we've got some between 36, 46 days. The answer actually is, the average is 46 days. Used to be 35 to 45. It's gone up to 46. I know in my area, they typically say it does take about 60, just because there are so many homes being sold that it takes a while for the appraisers to get to the houses. So it, again, depends on location, depends on type of loan, but don't expect it to happen overnight. It does take a while. So these are the few things that need to be done after your offer is accepted. An inspection, there's some documentation you'll go through, getting your insurance, an appraisal on the property, doing a title search, schedule your closing, and then close. So the inspection, what is this? You want to hire a licensed professional inspector. Your real estate agent can really help you with this, finding somebody. This is something you as the buyer will pay for, and typically out of pocket up front when they come. So the cost is going to be anywhere from $300 to $500. Plan on being present at the inspection. So you might get a report. I think ours was like 60-some pages, had great pictures, great information that they provided to us, great checklist, went through every corner, nook and cranny of this house. But being there, they could go over some things that they were more concerned about, and kind of how important that was, and how to approach the sellers then to see if we could get any of that stuff fixed before purchasing the home. So really have that conversation with them about possible problem areas. How big of a problem is this? And then read the report thoroughly and ask questions on items you weren't sure of. So I know that was something, I saw a picture and I was really nervous about it, and I contacted them and they said, really, the picture's worse than it actually is, not a big deal. This typically isn't going to be required for you to get a loan, but you should have your property inspected. Throughout this process, you can learn more about the home, and then also make those requests from the seller to make those repairs if need be. Then there's going to be some documentation that you get from your lender. You're going to get some initial disclosures, so your loan estimate. After you have provided your lender with the purchase and sales agreement or have a complete application, you'll receive this loan documentation. It's important to properly review it, complete it, sign it, and return it. You may also get the opportunity to lock in your interest rate. Depending on when the closing is, you may or may not want to lock in your interest rate. Some borrowers may opt to float in their mortgage interest rate. The interest rate may and will change until the rate is locked in. So we've noticed the last few weeks how interest has kind of been going up, creeping up there. I was looking at homes and realized that, oh, interest is almost 2% higher now than it was when we purchased a home almost 2 years ago. So now we're probably not going to be buying another house. But really, locking in that rate is really important if you're worried that it's going to be increasing. Make sure to address all of your lender's questions and requests in a timely manner. I just got a question about a lock rate, so I will answer that since that's what we just got done talking about. Can you lock in a rate as soon as price agreed to if you have a 60-day wait? I'm wondering what you mean by a 60-day wait, like a 60-day closing. I know I was able to lock in my rate and had a 60-day, that was the clause in the 45 to 60 days till close. Yes, correct. Yep, I was able to lock in my rate for 60 days. And then I think we went to almost 62 or 63 because of something happened. And my lender just said that they would extend that a few days. But I'm assuming interest probably didn't change and they weren't too worried about it. So yes, you can lock in interest sometimes for 60 days. Just ask your lender and they'll tell you how long they'll lock that rate in for. If you have any changes to your application during the process, contact your loan officer immediately. So if something comes up, or don't blindside them, because then they might panic a little bit and you might not look as trustworthy as you once did when you first completed the application. Just know that homeowners insurance, you'll need to provide your lender with the contact information for who will be handling your homeowners insurance. The lender will request a binder from your homeowner's insurance policy. This needs to be done as soon as possible, as soon as the premium is part of the, if you want to have that premium part as your mortgage payment. So if you plan on opening escrow that's going to cover your taxes and your insurance, it's really important to get your homeowner's policy set up as quickly as possible and have them send the information to your lender. Next thing is the appraisal. So an appraisal, if you're buying a home, the appraisal is typically ordered after the home inspection, assuming there is one, and it's been, excuse me, and it's been done and the results are satisfactory. When the lender receives the appraisal back, it is reviewed by underwriting, and we'll talk about underwriting here in a minute, and then you do get a copy of the appraisal report as a buyer. If the appraisal comes in less than the sale price or expected value of the home, you'll most likely review possible options with your real estate agent, your realtor, and your loan officer. So sometimes you can reduce your offer. You can come up with the money, but who wants to buy a property for more money than what it's worth? Yeah, like I said, kind of change your offer as well. A lot of times when you make an offer on a house, it will say contingent upon appraisal, so that way you don't lose your earnest money deposit if the appraisal comes back way less than what your offer was. So be really, and if you have a realtor, they'll have that in there for you, but just be aware of that, making sure that that clause is somewhere in your offer so that way you don't lose your earnest money deposit. So title search and insurance, this really, to me, kind of happens on its own. It's a search to ensure the property can legally be transferred, because your lender doesn't want to lend money against a house that may have legal claims on it. So a title company will perform a title search and make sure that the property can be legally transferred. The title company will research the history of the property, look for issues including mortgages on it, claims, liens, assessment rights, zoning ordinances, pending legal action, any unpaid taxes, and then restrictive covenants. And then the title insurer then issues an insurance policy that guarantees that work. Okay, so it's basically this title search and insurance is saying that this house can legally be sold. There's nothing, no way that somebody can come in and take this in the future. Underwriting approval. So you have a lender, and then they have to have their work go through an underwriter. Once processing has a complete loan application and supporting documentation, they'll submit the loan to underwriting. These underwriters will review the application, all the documentation, and lender guidelines. They will then issue a conditional approval or possibly deny or suspend the file. Assuming the loan is approved, there may be conditions to the approval that need to be resolved before it can be cleared to close. You have no idea how good it is when you are buying a house if you haven't purchased a home ever. When you get that clear to close, you're like, oh, thank goodness, it took a while. Examples of the documentation they may want. They might want a letter explaining your employment history. So if you have not been employed in a position for 2 years or more, they're going to want some information on that from you. You might have to provide some updated pay stubs. So if it's been a while since you went through the pre-approval process, if you're missing pages of a bank statement, because they will go through everything. They look at every piece of paper. When we purchased the house, underwriting wanted my last 2 pay stubs from my new job, or my first 2 pay stubs. I apologize for that. But it didn't work that way because I was only going to get 1 pay stub before I started working. So we actually had to, HR, Human Resources here, had to send the bank letters every few weeks saying that she's still employed here. So they were worried, I guess, that I was moving for a new job and would just buy a house and not start working. So they got around the 2 pay stubs by having Human Resources send them a letter every so often saying that, yes, she's still showing up to work and still coming in and receiving a paycheck. After that initial underwriting approval, the file is sent back to processing to work on getting the items requested by the underwriter. So there are 2 main types of underwriting conditions. There's prior to doc. These are items that must be resolved before documents can be ordered, or prior to funding, which means items must be resolved prior to closing of the loan. Review and resubmission and conditions. The processor and or mortgage originator will work on obtaining the conditions. So there are both automatic and manual underwriting. So automatic underwriting is where everything goes through a computer process, and it is speedy. However, there's really no, they can't make a case-by-case decision if it's done through automatic underwriting. So manual underwriting, yes, it may take a little bit longer, but they can then look at conditions and things a little bit differently. So you've made it through underwriting and you get kind of your clear to close. What should you expect in your closing costs? So a buyer and seller may have closing costs. Each one has different closing costs that they must pay. As the buyer, you may negotiate to have the seller pay some of these closing costs. So you might have written that into your offer saying, we'll pay full asking price for this property, but we're asking the seller to pay up to $5,000 of our closing costs. So that is an option. Again, work with your realtor. They'll help you through that process. But here are some of the buyer closing costs that on this screen. So the appraisal, you do pay for that, and you pay that when you close on the loan. Any origination fee from the bank, if they have one. Prepaid interest, prepaid insurance. So yeah, just kind of that list of the different things on the screen. So getting to and through closing. So call the utility companies. You're going to be closing pretty soon. Have things put into your name. Final walkthrough is so important, which I'll be honest, I didn't realize how important it was until we did our final walkthrough and then moved in and realized that between the inspection and when we closed, the hot water heater broke. And so when we moved into our house, we had no hot water. Because we didn't check the water during our walkthrough. So yeah, and if you had any conditions like we needed to have handrails put on at the stairs for safety reasons, they make you do that with a VA loan. So making sure that's all taken care of and done. And sometimes they actually want documentation of that as well. So Your closing documents, it's a form that lists the final terms of your loan that you've selected, final closing costs and details, and who receives money at closing. So you should get that about 3 business days prior to closing. So that is one thing as well. If you don't have your final paperwork and you think you're closing tomorrow, you're not. It's required that you have those as a buyer for 3 business days or you can't close. If you do have to pay your down payment or closing costs, make sure to bring a cashier's check. They will not take a personal check. They will not take a credit card, so think about that. And then you'll get your initial escrow statement. This lists your estimated taxes, insurance premiums, and other charges during the first year of your loan. Your lender will help you go through all these papers. The title company will be there to go through as well. Don't sign anything unless you completely understand it. There will be somebody sitting there with you explaining this all to you, and ask questions. You know, they'll go through, is this a loan that, you know, it'll go through every single term. So we have one, you did a walkthrough, but after moving in, most of your interior doors would not close. Yeah, check everything. It's so important to check absolutely everything on a final walkthrough. You know, you think, oh, the inspector did it. Well, that was a month ago. So that final walkthrough is essential. We did ours the day before and didn't think much of it. They still had some trash in there and they were still moving out. Well, the trash was still there when we got our keys and moved in. So yeah, check everything. Make sure you write things up that this needs to be taken care of before closing. So after you've gone through all of that work, all of that stress, it's time to get your keys and move in. So enjoy your dream home. So like I said, there are 4 steps. However, those 4 steps take a while. So from start to finish, it can take you, you know, probably 4 to 5 months from starting to look to closing, unless you really know what you want and you're buying from family or something like that. So while you think of questions, I'm going to ask a few questions of my own, kind of how things went today. These will not be broadcast to anybody. These just kind of help us gauge how we're doing with the education. And then again, I will go back to the other screen. If you do have any further questions, we've got a few minutes here. Okay. All right, so I'll give you a minute here to ask some questions. I know we did have some questions that came in throughout the presentation, so I'm glad for that. I'd rather kind of do it while we're on a subject. So, and just to remind you, next week we will be talking about different home loans and different terms with home loans. Joel will be doing that presentation for us next week. And then we'll take a break, and I'll be doing student loan repayment options on March 21st. This does remind me, if you do have student loans with mortgages, there was a new law or a new rule that came out. It's not a law, in 2016. So if you are on an income-based repayment and you have a mortgage, or you're applying for a mortgage, they will take 1% of the remaining balance of your student loans, not what your income-based repayment is. So if you're trying to calculate your debt-to-income ratio, you may say, well, I pay $200 a month in my student loans because you're on an income-based repayment plan. However, let's say you owe $75,000 in student loans. The bank is going to say your monthly payment is $750, not $250. So just kind of as a heads up, if you do have student loans, you're on an income-based repayment, it's gonna change your debt to income ratio, and it's not going to be what you think it is. All right, but if we have no other questions, thank you all for joining us today. And if you have any questions in the future, please feel free to reach out to us and ask. Thank you so much.